VanEck is a leading Australian ETF provider, and I spoke to their Deputy Chief Investment Officer, Jamie Hanna, about what's driving the popularity of gold ETFs at the moment, the opportunities that are developing in emerging markets, and precisely what systematic investing is and what's driving its rise. Take a listen. Jamie, as an investor, be it someone who's beginning or perhaps even someone with a lot more experience, it's still difficult to pick apart the present picture and try and make sense of it. There are a lot of different moving parts. On the one hand, interest rates seem to be falling, but stocks are quite fully valued at the moment, depending on where you look around. There's a lot of movement when it comes to precious metals and currencies. How do you start making sense of all of this?
Well, I think you just need to think overall picture. We know what's going on in the world right now. We know that the US administration is making big changes to the global economic world order. We know there's war and certain political fallout going on across Europe. We've got Japan issues as well as South Korea. So every part of the world has particular issues going on at the moment. I think you can kind of get overanalyze some of these issues and try and think too much about them, because arguably you can't really influence a lot of these issues generally. So if you're thinking about it from an investment point of view, you just need to adjust your portfolio with a long-term outlook, right? And it's obviously, investing 101, where you're thinking a well-diversified portfolio. So you need a mix of assets across different asset classes, not just shares, not just Australian shares, international shares, bonds, commodities if you can get them in as well. And so it's really just diversifying the portfolio, which will obviously give you enough upside, right, with the political environment and the markets hitting all-time high, but being able to absorb any downward pressure, because you never know when the top's going to come.
Yep.
Right? Anyone who tells you the market's fully valued was probably wrong, and the market could continue to hit all-time highs for the next couple of years. So you don't want to miss out on that. So just making sure your portfolios align and trying to ignore some of this noise coming out of all the geopolitical issues that you can't influence is kind of key.
Does it strike you as odd that you have all of these heightened risks, but then at the same time you have equity markets, for example, hitting record highs in whatever jurisdiction that you look at? What do you put all that down to? Well,
I think, it's difficult to say why the market is as high as it is. When you think about all the risks that, we just kind of spoke about, there is no answer other than there seems to be risk-on sentiment, which means people are willing to put their capital at risk by making investments right now. For whatever reason that might be. It could be policies, it could be their own decisions, it could be where they're thinking it's going. So there is just capital flowing into the markets, and it's pushing up asset prices. And it's not just shares, right? I mean, it's property as well. I think, and this is a big call, but if you look back over the past 15 years or so since the GFC kind of rolled out, the market's been in a bull market pretty much consistently, except for the COVID drawdown in 2020. So it's, if we look back from a future point in time to where we are now, it's arguable that we never came out of the GFC until COVID lockdown in 2020, because the market and
you mean
the
in terms of the broader cycle?
The broader cycle, because governments were printing money, and pumping it into the economy around the world, and that really just gave everyone extra money to buy assets. And hence we saw property booming, we saw them, the equity markets booming, and we're going through a little bit of a cycle of that now, but now we've actually seen inflation come through. So people are actually having to rethink about what's happening globally. But arguably, when things are, going in one direction, momentum-wise, it tends to go that way for a while.
We tend to focus a lot on developed markets in terms of our conversations, but with the Trump tariffs and the fluidity of the US dollar and interest rates in particular, emerging markets are placed in a precarious position. What view do you take on emerging markets in the current environment?
I think I'm relatively positive on emerging markets. If you think about the last decade, about 60 to 70% of the world's global growth has come from emerging market economies. And we're talking the likes of China, India, Indonesia, Turkey, Poland, Brazil, right? So those types of companies are really fueling and have fueled a lot of the global growth over the past decade, and I don't see it changing. Within these countries itself, we have, big changes socially, where a lot of people are moving out of working class into middle class. And middle class people have different aspirations. They need healthcare. They're more likely to buy new technology that's released. They're more likely to have money to invest. So those types of things are playing out within these countries. And if we look over the last year, China, is up 50% essentially over the past year. But if you actually go back over 5 years, it's relatively flat. Whereas you take India, India's had a stellar couple of years as well. I mean, these are huge growth numbers. So it's very difficult to pick because you get sovereign risk. You only have to use Russia as an example. Russia was a bit of a darling for a while in the emerging market space, but obviously what's going on right now, it's essentially been blacklisted from the financial markets. So you have these other risks. You have political risk and that as well, like corruption. But I dare say all these issues that are going on in the emerging markets, I think we're partly seeing it play out in the developed markets now. So we're no exception.
When you focus on developing an ETF that's leveraged to the evolution of an emerging market, is it simply just focusing on those companies that are going to benefit from an emerging middle class?
It's part of it, right? I mean, when we're building out a product for emerging markets, we need to weigh up what market it is or if it's a broad-based. If you're buying an individual country in the emerging markets, there's increased risk. So you're buying straight China or straight India, then you are completely exposed to all the political, goings on within that country. Whereas with a broad-based one, you're getting a broad-based exposure across all of them, and so you get different performance metrics out of that. And in the developed world, in the developed markets, when the US does something and Europe does something and Australia does something, they generally move in the same direction, right? So what you'll find is if America falls, Australia will invariably fall. In emerging markets, it's not quite the same. You can have Brazil doing really well and China falling. So they're very much different economies that are not tied together like you would get with the developed markets. And hence different kind of strategies play out. While I said China's up 50% over the past year, but fell relatively flat over the past 5 years, emerging market broadly is up 20% over the past year. But if you go back over 5 years, it's up 80%. So it gives you less individual exposure, but maybe lowers your risk across all of the individual markets.
Some of the best performing ETFs that you have in Australia are quite niche in terms of their themes, I suppose. One of them focuses on esports in particular. Tell me about that ETF.
Yeah, so look, Espo is esports and gaming. And I'll be honest, not a lot of revenue actually generates out of esports. It's primarily out of video gaming. And a lot of people don't really think about video gaming as being a particular industry. But actually, when you drill into it, the video gaming industry now globally earns more revenue than the movie and music industry combined. Right?
That's an extraordinary statistic, isn't it?
It is. And I don't necessarily see that changing in the short term. Because what's really happened, we've gone from video games where people would go and buy the game and bring it home and play it on their PlayStation or computer, to now being connected to the internet. You can actually purchase games at home. There's a lot of in-app purchasing. People can play them on their phones when they're out and about. And the younger generation have really taken to this. And it's, certain parts of the world more so than others. And so this technological change is just really driving innovation and driving monetization of the video gaming market.
Now, gold has been another high-performing ETF from your vantage point. Is it straightforward that you've got increased geopolitical risk at the moment, so investors are trying to find something of a hedge through the yellow metal?
Look, gold hitting all-time highs at the moment, $3,600 an ounce. I mean, these are big numbers, right? So yes, I think there's a lot of people hedging their risk when the markets are so high. They're looking for alternatives to try and, allay some of the inflationary risk first of all, and now trying to allay some of the risk associated with high valuations across equities and property. So yes, definitely is a risk source, but we're also seeing extraordinary flow linked to gold mining companies, because gold's at 3,600 US an ounce. Gold mining companies are mining it out of the ground roughly around 1,500. So this huge rally in the price of gold has really just, supercharged the profits of gold mining companies. And we've seen them rally extremely hard. But it was very slow. to start.
Yeah.
And so, yes, they've picked up considerably since the start of the year, but there's maybe some potential value still in the gold mining companies because they're leveraged to the price of gold. So maybe if the gold price keeps going, the gold mining companies are still a potential option for some form of value in this overpriced market.
I suppose there's almost something in the relationship between the performance of gold and the performance of defence stocks that almost seems to be correlated quite closely. When you're putting together a defence ETF, how do you make sure that you've got all of the right components?
Look, for us, when we built the defence ETF, we really focus on the fact that we don't want companies in that are involved in controversial weapons. White phos, depleted uranium, the list goes on. So realistically, we've taken the universe of defence companies and eliminated the companies which are involved in controversial weapons manufacturing. Realistically, that cuts out a few of the major ones, but still keeps the broad base of defence companies, the contractors, the aerospace companies, a lot of the IT. So they're still very much involved within our defence ETF. And realistically, it's performed better, if not the same, as the ones that have the controversial weapons in the ETF.
What the last 18 months has really been defined by a significant ratcheting up of defence spending globally. How much of a tail do you see that as having?
It's a massive tail to the underlying performance of defence companies. If governments are increasing defence spending from 1% to 3% or even higher, then we are talking tens of billions of dollars worth of flows into defence manufacturing, into defence companies. So this is probably one of the biggest tailwinds since World War II to defence companies, as a lot of militaries try to, ensure that they're at the cutting edge of military technology. And to do that, they have to spend the money, they've got to invest in it. And we're seeing that the existing companies who are already in the defence industry are winning a lot of big contracts. And hence, you've seen a sizable rally in defence industry and defence companies over the past year.
Jamie, it's really important as an ETF provider to be innovative, to be looking over the horizon, anticipating customer needs in terms of what their investment appetite might arrive at. What are you thinking about at the moment that's a little bit further down the field in terms of anticipating customer investment needs?
Yeah, so for us right now, I think there's been an evolution, right? Previously, people were just buying managed funds. Then we had ETFs come online where you can actually buy an ETF, listed on the exchange. I think what you'll find now is that a lot of companies are moving more towards systematic investing, right? And this is where you take out the noise of the individual portfolio manager and you very much employ, programmable learning. It's not necessarily artificial intelligence, it's being able to take huge data sets and analyze them in instantaneous atmosphere.
So you're being dispassionate in terms of the application of the principle rather than having that human lens involved.
Yeah, look, human lens does work, but it's also biased, right? We all have inherent biases within us, especially if you've made money on a particular company before, you're more likely to have a look at it again and potentially go back in when maybe you shouldn't. So by actually using the systematic investing approach and the way we do it, it takes out that human bias. And it's able to analyze data on a far greater scale than what we can do individually or even within a team. So we can analyze thousands of data points every second, right? So it's able to, put that all together and essentially, make suggestions to the portfolio manager in terms of how they deploy their capital.
So that's called smart beta. Where are we in the evolution of this sort of technology when it comes to investing?
We're only at the start of that. So look, I would say that, this systematic beta, in terms of how it produces and how the computer technology evolves, it's only as good as the code that you write, of course. So I very much think that we're only at the start of this journey, and I think that there'll be some hits and misses over the next decade, but eventually it could replace a lot of what we know about investment, in the long term.
Jamie, great insights. Thanks for your time today.
Thank you very much, Tom.
And thanks for joining us for the Executive Series.